And this is Bloomberg Technology. Coming up in the next hour, go for liftoff. Shares of the ride-hailing company originally surged as much as 12% after hours as the company beat analyst estimates for the second quarter. But news on Lyft's lockup period ending earlier than expected, causing new volatility in trading. We will bring you the latest on Lyft's results from one of the earliest investors. Plus, FedEx drops Amazon. The delivery giant says it will not review its ground delivery contract with Amazon as the online retailer expands its own shipping and logistics game. We'll talk to one of the founding members of FedEx Ground. And new phones, new features. It's Samsung's first look at the new Galaxy Note 10 and Galaxy Note 10 Plus from its Unpacked event in Brooklyn, New York. We've got all the details. First to our lead, a rebound in tech shares helped fuel a recovery in U.S. equity markets. The day starting Wednesday with an ugly open as traders hit the eject button without any clear catalyst. But an afternoon turnaround in names like Apple, Microsoft, Broadcom helped erase losses across major indices. And speaking of Broadcom, it's still to buy Symantec, maybe near. That's according to Dow Jones. Symantec surged in after-hours trading on the news, up as much as 20%. The gains in tech fueled the largest recovery the S&P has seen since December of last year. The Nasdaq also closed in the green, while the Dow ended the day fractionally lower. Joining us to dissect the moves, our Bloomberg MLive senior markets editor, Mike Regan. So, Mike, talk to us about Broadcom here. The report that Broadcom is nearing a deal to buy Symantec's enterprise business.
Yeah, right. Dow Jones reporting this deal after the close, saying it may happen as early this week. It's valued at about $10 billion. And as you showed, a tremendous rally after hours in Symantec, up as much as 20% at one point, came back off of that high level and is up something like 8 or 9% right now. There you go, 13%. Still a pretty big rally after hours for Symantec. And clearly this type of thing, this type of deal potentially could be bullish for the tech sector writ large. Of course, Symantec, a niche provider of security type of products. So clearly something a lot of companies would want to get into in this day and age with all the data breaches we read about. But that said, you know, not necessarily the type of thing where there's a lot of other businesses, a lot of other publicly traded stocks that will sort of get a halo effect from this tomorrow, but still a pretty bullish catalyst for the tech sector.
All right. Why did tech rebound in particular so fast today?
Well, it's interesting. You know, it's one of those days, as you said, they're not exactly a clear catalyst. The futures market before the cash exchanges opened was actually higher in the morning. Then it spiked down very abruptly before the open of exchanges. There wasn't seem to be any sort of fundamental or news-driven reason why. I tend to believe that when volatility is introduced into the market, like it was on Monday of this week, that there tend to be these sort of unexpected swings, both up and down, that are very hard to explain. And it kind of takes a few days for the market to sort itself out. I would point out, though, that tech was not the leader on the downside today. That's a bit of a change of flavor from what we've seen in this entire correction. Tech, semiconductors especially, hardware equipment makers were very much in the lead on the downside of this correction in stocks we've seen over the last couple of weeks. Today, though, it was kind of not necessarily the trade war itself that was causing the weakness earlier today, but rather the knock-on effects. We saw this tremendous rally in Treasury bonds and bonds across the world, really, and that really reduced interest rates sharply. So it was banks in the lead on the downside today. If you remember, tech rebounded yesterday. So despite the fact that it's very hard to predict where these swings are going to sort of shake out over the next few days, it is kind of encouraging, I think, if you're a tech stock investor, to see this follow through today from following a rebound yesterday as well.
And what about cryptocurrency? Bitcoin, fairly stable over the last couple of days, a big spike up on Monday, despite the volatility we've been seeing elsewhere. Is this sort of a safe haven?
Well, there's a lot of debate about that, Emily. I mean, people are talking about the correlation between Bitcoin and gold really getting high again, which would tend to suggest that it is being viewed as a sort of a safe haven asset. I would also point out there that Bitcoin tends to be the type of thing that could rise because on Monday, when China's currency was very weak, there was a lot of speculation about capital outflows leaving the country to avoid this weakening currency. And clearly, Bitcoin can be a beneficiary of anyone trying to get money out of China and into other assets. Mike McClone on Bloomberg Intelligence, though, put out a very interesting report saying the one thing kind of standing in Bitcoin's way now is that its short-term volatility is very high. I mean, obviously, Bitcoin's a notoriously volatile asset, but traders and investors in it get used to a certain amount of volatility. When it gets even higher than that in the short term, from his work, it tends to sort of put a lid on prices in Bitcoin. And if you look at the chart this week, it's having a very hard time staying above that 12,000 level. I think there is a bit of a safe haven appeal to it, as well as that China capital flight appeal, but it'll be interesting to see if it can finally crack that 12,000 level and stay above it.
All right, we shall see what tomorrow brings. Our MLive senior markets editor, Mike Regan. Thanks so much, Mike, for that update. Now, to our other top story, Lyft earnings. Shares of the ride hailer popping on second quarter earnings results that beat estimates. The company reporting revenue reached $867.3 million, up 72% from last year, but the good news quickly overshadowed by the company's decision to allow shareholders under lockup restrictions to sell earlier than anticipated. Lyft announced this lockup period will end August 19th, which is when more than $16 billion worth of equity will become eligible for sale. I want to get perspective now from one of Lyft's earliest investors, Oceanic Partners CEO Tim Sullivan. And Lyft shares going into this, Tim, had been down 15% since the IPO. You knew about the lockup expiring earlier.
Yes.
Why are they doing this?
There is, and this was in the S-1 filing originally, but there's a restricted stock unit plan that is causing this lockup to be moved up from September 24th to August 19th. So it is coming off August 19th, and we're not selling. We're in it for the long haul.
Why?
I still, believe strongly in the management team. The founders are doing a great job running the day-to-day, business at Lyft. Obviously, the numbers were phenomenal this quarter. 867 million top line. The projections were, 810 million. So I think Lyft's doing a great job of not only managing expectations, but beating expectations, which is obviously great for Wall Street.
They did lose their COO leaving the company. They're not going to replace that person. They're going to fill the job in other ways. I mean, from a management perspective, since you mentioned management, is that a concern?
No, I think John Zimmer has kind of been the COO de facto since the beginning.
And president and co-founder.
Right, and having somebody come in and try to duplicate his effort didn't really make sense. It's kind of the same thing that's going on at Uber as well. They just lost their COO because Dara, I think, is also trying to play more of a hands-on role. So that's what you're seeing at both companies.
Does the lockup ending concern you and all those shares potentially hitting the market even as the share price is down? I
think that's just the way things are these days. With unicorns going public and that many shares hitting the market at lockup expiration, we've seen over and over with every company that we've invested in. The stock takes a pretty significant hit when those shares hit the market. People are, hungry for liquidity, and when they have the opportunity, they take it. So
let's talk about the future. I mean, the story of if Lyft versus Uber has been price wars almost as long as they have both been in existence and getting the lowest price, but that means lower revenue, less incentive for drivers as well. Is there an end to that anytime soon?
I think we're still in early days. I think we've got a long way to go, but I think we're going to see less drivers and those drivers making more money in the future.
Why less drivers?
Because I think the business model is geared toward full-time drivers, and you're going to see less of those, I think, in the future.
So if less drivers make more money, do the companies themselves still
because
make more money?
Their take rates go up and the companies make more money as well.
So what does that mean for the competition between Lyft and Uber longer term? Is it more about the brand and which company has the better brand?
I've always thought that there was room for a Coke and a Pepsi, in the ride-hailing space. It's incredibly disruptive. It's a huge market, and it's, again, in early days. There's still a lot of growth to come. There's room for both Lyft and Uber.
But when do they get to, or do they ever get to profitability? I mean, the two companies combined lost $2 billion in the last couple of quarters.
Yeah, no, the path to profitability conversation is one that is, I think, top of mind for Brian Roberts, the CFO at Lyft, and probably, that's the most important thing for him on a daily basis. But I think autonomous vehicles, I think electric vehicles, I think there's lots of different ways to achieve that path to profitability.
Autonomous vehicles are so far out.
I believe that's correct, yeah. I think they're a lot further out than most people think.
So then is the path to profitability a lot further out than?
I think there's a bridge with electric vehicles. I think that Lyft can take advantage of things like charging stations, the city bikes in New York City and other infrastructure that exists today to provide vehicles to drivers that require a lot less maintenance, that are much lower cost, that incrementally add to the bottom line for everybody, for drivers and for the company.
All right. Well, Lyft shares up almost 2% after hours. Tim Sullivan of Oceanic Partners, always good to have you here.
Thank you.
On the show. Thank you. Coming up, FedEx snips another tie with Amazon, announcing the end of its ground delivery contract. We will talk to one of the founding members of what became FedEx Ground next. This is Bloomberg. Shipping giant FedEx is offloading its ground delivery contract with Amazon. It's the latest move by FedEx to reduce its dependence on Amazon as the online retailer builds out its own logistics network. With more on the implications and how this affects both companies, Bloomberg Intelligence's Jitendra Rawal will be with us. And on the phone from Philadelphia, we've got Satish Jindal of SJ Consulting, a founding member of the company that became FedEx Ground. So Satish, who does this hurt more, FedEx or Amazon?
Amazon is so big, and they have built their own capability to deliver their own packages so rapidly in less than 2 years that Amazon is not going to feel any pain from this. And in fact, I would tell you that as of June and July, they have not been using FedEx at all. So it is an academic exercise that FedEx is terminating its contract because there was no business FedEx was getting anyway. So FedEx is the one who will have to replace that volume with other e-commerce shippers.
How does FedEx replace that volume?
How do they replace it? By offering that capacity to other big guys like Walmart and Target and Kohl's, who are fairly large shippers of FedEx, and making that capacity available so they can have some of the business those retailers were giving to UPS or post office and have it be converted to FedEx.
Jitendra, would you agree, no pain for Amazon, just a lot of work for FedEx?
Yeah, so if you look at what Satish said, I think Amazon spends more than $31 billion in shipping every year, right? This is a couple of $100 million business with FedEx. This is a long time coming. This is not something that's was unexpected. The variability and the risk here is not revenue. The risk here is like margins. So now Amazon is moving to one-day shipping, going into the holiday season. There's a lot to cope with. Obviously, USPS is there. They have their own capacity expansion as well. But if you remember back in 2015, they missed because their capacity was overwhelmed and they had to pay more for shipping. Mm-hmm. So shipping variability, margin variability, that's something to think about. But from a long-term perspective or from a top-line perspective, this was largely expected.
So Satish, as somebody who founded the company that became FedEx Ground, what do you make of the longer-term prospects for FedEx, given that they're keeping their relationship with UPS? They've obviously got a relationship with the Postal Service, and FedEx globally has had some patchy issues, struggling particularly in Europe.
You asked a great question. I think you're going to see that for the next 3-4 quarters or more, the company is going to be challenged to produce results that are desirable from their shareholder perspective. They have lost express volume. They're losing some ground. And it is not going to be easy. It takes time to have customers replace another carrier with FedEx. So there's going to be a lot of hard work and tough times ahead for FedEx until they recover from it. And long term also, when you terminate a customer and then you put a press release out, it leaves a bad taste in the minds of the shipper. And Amazon would be very reluctant, even if they have FedEx coming and knocking on the door that we'd like to handle your peak season volume. Amazon is going to think twice before they give them any business again.
So, Jitendra, what about the other companies like, Satish mentioned Walmart, but Target and all of these companies that are trying to compete with Amazon on delivery to narrow their own delivery times? Could this be an opportunity for them?
Well, Walmart in particular has the biggest tractor delivery network here in the U.S., private network, if you may. So they are definitely well equipped to handle their own. But like you said, there's a lot of direct-to-consumer demand. It's a 3P shipping model or third-party revenue model that Amazon has been sort of like benefiting from a long time. You have direct-to-consumer demand. The companies that do not want to sell on that platform, want to sell by themselves or on other platforms and things like that. Maybe that's an opportunity they can go after. It is a big market in the end, but like losing access to 300 million plus customers that are willing to buy your products because you're on the platform, obviously, holds that big volume back. So it's going to be a wait and see. But as far as Walmart is concerned, they are equipped.
All right. Jitendra Rawal of Bloomberg Intelligence, Satish Jindal of SJ Consulting. The logistics wars continue. Thank you. Coming up, Samsung has announced the latest generation of its Galaxy Note phone line. How do the new phones help the company ward off competition from Apple and Huawei? That is next. This is Bloomberg. Samsung announced the Galaxy Note 10 at its annual Unpacked event Wednesday. The Note 10 will come in two sizes, a 6.3-inch model starting at $949 and the Note 10 Plus, a 6.8-inch version with the choice of 5G. The new phones will be vital to Samsung as it tackles sliding smartphone profitability and increasing competition from Apple, Huawei, and other Chinese vendors. Bloomberg's Mark Gurman spoke with creative strategies analyst Carolina Milanesi at the Brooklyn event and asked her about Samsung's services strategy. Take a listen.
I think from a services perspective, Samsung is going to try and leverage a relationship versus starting and creating their own services. Consumers have already made their bet as far as content, and so leveraging those relationships and making sure that the experience that you get on a Samsung device is the best experience that you can get, I think is what they're trying to achieve. Think, for instance, what they announced back at CES and the relationship now that Apple channels have with Samsung TVs. I think that's an easier play for Samsung than not starting with their own content.
Got it. Now, in terms of the upgrade that we're seeing here from the 9 to the 10 and 10 Plus year over year, do you think this upgrade with the bigger screens are enough to really pull people from other ecosystems, whether that's, Apple devices, Google has their very small slice on their own phones, the Pixel phones. People are going to upgrade. Are they going to upgrade from the Note 9? Who do you see buying these new devices?
But obviously, the core audience is always the Note owners, current owners. But I do think that from an Android ecosystem perspective, there's an opportunity for Samsung as they change the design of the Note and making it more mainstream. I think it's very smart to diversify on the screen size as well. Women tend to prefer smaller devices than larger devices, but they need productivity and being able to juggle everything they do as much as a man does. So I think that opening up a broader opportunity for Note is very smart.
Now, what about the market? The market has been going down the past few days. How does Samsung play into the trade war? Obviously, that's pushing the market down quite a bit. If you look at the Dow Jones, the S&P 500. What's Samsung's involvement there, and how do they compare to Apple and the impact they are potentially having from these tariffs?
I see two main differences between Samsung and Apple and how they respond to or they get impacted from the trade war. One, obviously, that Samsung is not American, and so to some extent they are a little bit, they're not as impacted as in that back and forth between Beijing and Washington. The other part is that, unfortunately, at the moment, from a market share perspective, China is not a strong market for Samsung, so everything is an opportunity versus being hit negatively on what there currently is their market share.
I know you've been testing the Apple Card on an iPhone. I know you test all the phones, but the Apple Card, you've been using it. Do you find just in your few days of usage that this is going to become like a core component of a phone, just like a streaming music service? And do you think that's something Samsung would eventually need to play into?
I do think that if you get more and more into financial services and health, those are two key parts on the Apple side that will create stickiness and might actually shield consumer from looking at the iPhone and thinking, well, maybe it's not the most cutting edge device, but because now it's my wallet, because now it is my link to my doctor, I will keep, and so the stickiness through the services increases. I think for Samsung, looking at health and the pairing with the active watch that they just announced a few days ago is probably the first step. Financial services might be a bit harder for them.
And lastly, of course, I have to ask you about the Galaxy Fold, that nearly $2,000 phone that if you ripped the sticker off the screen protector would basically destroy the thing. How is that impacting the Note 10? Do you think there's going to be any fallout from those issues onto this other new line?
I don't think so. I think that the Note has a very strong and loyal base, and the Fold attracted somewhat different audience to it. I think that Samsung was smart in putting out a release just last week that there is a shipping date for the Fold, which is September, and I think that kind of put mind at rest of people that were being skeptical about the Fold hitting the market for real or not.
Creative strategies analyst Carolina Milanesi there. Coming up, U.S. lawmakers aren't too happy with Google. Now they're calling out the company over alleged plans to build a smart speaker with Huawei next. Plus, changes coming to Instagram. Why Facebook is merging its systems and rebuilding Instagram's chat product. Next. This is Bloomberg. In San Francisco. A trio of U.S. senators are continuing their scrutiny of Huawei's ties to American companies, and this time they are going after Google. Republican Senators Marco Rubio, Josh Hawley, and Tom Cotton are concerned over a report that Google was developing a smart speaker with the Chinese telecom, one that would be sold outside of China. They didn't mince words in a letter to Google saying, quote, "Given this background, it is hard to interpret your decision to help Huawei place listening devices into millions of American homes as anything other than putting profits before country." To discuss, in Washington, we've got Bloomberg's Ben Brody, who covers tech's corporate influence in the Capitol, and in studio, our own Mark Bergen, who covers Google. Now, reportedly, these plans to develop the smart speaker with Huawei were stopped in May, the same month that Huawei was blacklisted by the Trump administration, but certainly there had been concerns about Huawei, national security concerns that had been expressed by the president and the White House many months before that. So what do you make of these plans?
Yeah, so first of all, the letter is slightly disingenuous. The odds of a Huawei device getting into millions of American homes is pretty low. Like, Huawei can't even sell their phones. They're the second biggest phone maker in the world. U.S. carriers have not been carrying them for years. They're only sold online. So it's unlikely that if they even came out with the speaker that it would sell. Although Google has, it could be a Google branded speaker. We don't really know. I think, but the senators are getting to a point which is, Huawei has been a big, consistent partner for Google for years. In 2015, they built the Nexus phone, which was a Google-branded device. And Google, since the trade war and since the export ban on Huawei, Google's been pretty dead silent on their partnership and how that's going to change and affect their business.
Ben, this coming in the midst of lawmaker scrutiny of Google at its peak, along with scrutiny from the president himself. And at the same time, we've got a new rule going into effect involving the Huawei blacklist. Tell us the latest.
Yeah, so that is going to be going into effect. It was expected. It's going to basically be stopping the government from using Huawei gear either. So it's banned it from our networks. Now it's going to be banning it from, executive agencies and things like that here in the U.S. It was expected, but it is coming at a time when the trade war is really ramping up. All that news that we have been seeing out of China. So you have the trade war on one hand, as well as national security concerns about Chinese espionage happening through companies like Huawei and things like that. So it's that sort of escalation when those things come together that I think is really making this kind of interesting. And so we'll see people sort of comment on it and saying why they think it should be broader or narrower. But in this case, given that Congress actually sort of told the White House to do this, I think it's probably going to continue much the same way it looks now.
Meantime, Ben, the U.S. ban on Huawei is having global consequences. The U.S. has been putting pressure on other countries to take similar actions against Huawei. And now the Chinese are warning that there could be reverse sanctions on some of those countries. For example, India. If India bowed to, let's say, U.S. pressure to stop doing business with Huawei, the Chinese now saying that they could be subject, Indian companies and products could be subject to reverse sanctions by China.
Right. I mean, the complexity of all of these relations are things that people are constantly worried about here in Washington. We do know the White House has been pressuring a lot of our allies to keep Huawei gear out of their networks. That's been largely unsuccessful, even though it does seem that other countries sometimes share our concerns about Chinese espionage. But there's no doubt that trade war, national security, those two things are going together, and increasingly they become not just bilateral tensions, but really multilateral tensions on the world stage, and the White House is going to have to be dealing with that.
Meantime, Mark, just yesterday, the president took aim at Google over, again, alleging anti-conservative bias. This as social media companies remain under scrutiny over, what happens on their platforms. And they've now been invited by the White House to a meeting on Friday to talk about online hate in the midst of these mass shootings. Is Google going to be part of that?
They don't like to talk about this very much. They haven't gotten as far as I know. Google is certainly taking more heat now. There was a former engineer that we talked about on the show yesterday or a couple days ago, Kevin Cernicki, who's claimed that he was fired for being conservative, and he and others, former employees, have been very vocal, certainly to right-wing websites like Breitbart, sharing evidence that what they claim is evidence that Google and YouTube are censoring conservative content. And this is stuff that seems to be surfacing the White House, certainly in front of the president and his media diet, and it's probably going to be a topic of conversation that Google's going to have to address.
And quickly, David Cicilline, who's been leading the House inquiry into antitrust of big tech, is calling on the FTC to make some special qualifications to YouTube, especially as it pertains to children's content. He's asking the FTC to require YouTube to put all of its kids' content in one place, and also to not collect personal data or store personal data on kids under 13.
Yeah, Ben will have a better sense about sort of the political dynamics here, but it sounds like the FTC, as we reported, is in talks with YouTube about this children's privacy law. I read this as Congress saying, have some teeth with this, right? Actually, if you're going to enforce this, enforce it well and apply it to the world's biggest video platform, which we've talked about a lot, has this really strange issue where they say there's no one under 13 on the site, unsupervised, and yet if you go to YouTube, there's just this fountain of children's content that's been wildly successful for them and certainly helping with their advertising business.
All right, Ben, you'll have to keep us updated over the next few days about how that develops. Bloomberg's Mark Bergen and Ben Brody, thank you both. Switching gears now to Softbank, specifically its first quarter results. Masayoshi Son's company reported first quarter profit that beat the highest estimates and owes that to the success of the Vision Fund, the first Vision Fund, that is. Investments in companies like Slack and DoorDash managed to offset declines in value for Uber, and the company is getting ready to launch its second Vision Fund this year. To discuss, we've got Bloomberg Tech's global executive editor, Tom Giles. So, Tom, what are the biggest takeaways from these results?
Yeah, this is Masayoshi Son really transforming Softbank away from this sort of old line telecommunications company with a majority stake in Sprint. He's very confident that that is going to get the approvals that it needs so he can offload Sprint off the balance sheet and really position Softbank as an investor in up-and-coming technologies. As you pointed out, he's got a $100 billion Vision Fund. A lot of that money has been deployed, and he's starting to reap a return on it from companies like Slack, which went public earlier this year. DoorDash is another one. Oyo Rooms, this hotel business. And now he's embarking on Vision Fund 2, right? That's going to be launched very soon. You're going to start to see new investments from that fund of $108 billion. So he really wants to position Softbank as a cutting-edge company that's a savvy investor, even though sometimes those investments don't go quite as well as he had hoped, Uber being a case in point.
Well, and certainly many of the investments in Vision Fund 1 still haven't come to fruition. The question remains, can a Vision Fund 2 at that size be successful or as successful as the first?
Excellent question. And now there's a shadow hanging over the entire tech industry, which is the regulatory one that you were just discussing with your guests, Mark and Ben. And that is, there's questions about the global economy. There's questions about growth. The trade war is hanging over the entire industry. And so there's a lot of factors that will raise questions about whether new investments will work out as well as the previous slate of investments. Will you get the return? Not to mention the fact that when Softbank comes in, sometimes it comes in a little bit later when there's less upside for some of these investments. It has a tendency to inflate valuations beyond what they actually should be based on the soundness of the underlying business. And so Vision Fund 2, will it be as successful as Vision Fund 1? There's a lot of reasons to be a little bit more skeptical and less optimistic about its prospects.
So what are the biggest challenges going to be? They got to place the bets. They've got to find companies that are willing to take that money, and it's a lot of money.
Yeah, and finding smart businesses. We're through the cycle of where there was a lot of relatively easy money to be had in investing in consumer-facing ride-sharing, ride-hailing businesses like Uber, a big investment. And so, finding smart investments in an environment where there's less willingness for risk. Again, all those questions we talked about, the global economy, the trade war, and the outlook for the technology industry less rosy than it's been in a while. The other big thing that you got to remember for getting Sprint off the balance sheet and enabling people to kind of value Softbank as a savvy tech investor, the deal's not done yet. Sprint T-Mobile, it's gotten a lot of the federal approvals, but there's antitrust lawsuits from U.S. states. You still got to clear that hurdle. The chances are it will, but it's not unprecedented for a deal to hit snags this late in the game.
All right, Tom Giles, Bloomberg Tech, thank you so much for that update. Coming up, crunched in a trade war, we'll look at how a startup in Hong Kong is caught between the crosshairs of the U.S. and China standoff. That's next. This is Bloomberg. By now, you've heard plenty about how the trade war is hitting tech, especially in China. As Washington and Beijing continue to up the ante, companies are taking steps to protect their supply chains. Camera maker GoPro, for example, has moved some production out of China. Smaller companies face tougher choices, but can be even more nimble. The AI startup Miro has operated in Hong Kong for the last 2 years. It uses imaging recognition to track runners and connect them to brands. But as tensions mount, the prospect of relocating outside of China looms large. To give us a first-person account of the impact of the trade war, I want to get to New York, where Miro's CEO and co-founder Taylor Host is standing by. So Taylor, as this trade war has evolved and especially escalated over the last few days, how has your thinking changed on whether or not remaining in Hong Kong is the best idea?
Well, I think that it's been in the news as an economic item, but then also there's a geopolitical item in Hong Kong. Our decision to move or restructure our company to the U.S. has been a long time going. I think we do feel more solid in that decision. There's a heck of a lot of uncertainty that's been added in the last couple of months because of the unrest in Hong Kong.
So you are moving your company to the United States. That's decided?
That's correct, yes. So it's a difficult decision, but we feel confident in it.
Talk to us about what's involved in that. I mean, it's a pretty huge undertaking.
Well, I'm an American, so I'm no stranger to the legal culture here. It's a lot of lawyers. We're fortunate to have a great lawyer on staff as an advisor, and so we've definitely saved a lot of the cost and the headache there. In addition to that, it's about tax minimization. Really, Hong Kong is a very business-friendly environment traditionally, partly from a tax or ease of tax standpoint. But we already had a U.S. entity and many clients here in the West, so it was less of a struggle for us. We think that there are going to be some struggles for Hong Kong startups that haven't yet established a presence or an entity outside of Hong Kong if they choose to move. But nonetheless, it's always a difficult process.
What was your biggest concern about remaining in Hong Kong? Did you see it already impacting your business?
Definitely. I think that in the AI field, your clients trust you with their data, and we put privacy first and have since the beginning of the company. That is very well aligned with the Western approach to AI and data, and so it's helped us to confirm, by restructuring our business with our current clients as well as prospective clients. In addition to that, on the investment side, uncertainty, and Hong Kong certainly has a lot of it today. Uncertainty drives risk, and if we can remove a risk from the table from a prospective investor, it's only going to service us as we're raising funds.
So talk to us about how the technology works. Obviously, facial recognition technology, AI, especially for identification purposes, has become much more controversial.
That's correct. And we've built the system so that it operates independent of biometrics or facial recognition. We use the whole body to identify an individual, and we do it in a way that is GDPR compliant, but then also compliant with regulations in the United States. It's been a unique thing that we've been able to offer clients, and it's been a big part of our growth recently. So the technology is deep learning, and we throw lots and lots of data at some very interesting problems. The biggest ones being in the brand space. Shoe brand is our biggest play right now within the running space.
All right, well, we'll be watching to see how the business develops. Taylor Host of Miro, thanks so much for joining us.
Thanks, Emily.
Still ahead, Facebook takes its first big step to merge all of its different mobile apps, including Instagram, WhatsApp, and Messenger. We'll take a look at the changes coming to Instagram's chat feature next. Plus, Samsung's new Galaxy Note 10 comes with a bigger screen, more storage, and a new Microsoft integration. We'll talk about everything that is new next. This is Bloomberg. Facebook is taking the first major step in a plan to merge its messaging systems and let users exchange messages between all of its different mobile apps. According to people familiar with the matter, engineers are working to rebuild Instagram's chat technology on top of Facebook Messenger. This will make it possible for Instagram users to communicate with those using Messenger, something that isn't currently possible. But it does chip away at the independence of Instagram as a standalone product that has always enjoyed a level of autonomy from its parent company. Joining us now, Bloomberg Tech's Kurt Wagner. And the plan to merge the back end of the messaging parts of these apps has been incredibly controversial, but it seems like Facebook is not deterred.
No, not at all. I mean, this is the most logical step one, but it is step one, which is you take a service like Instagram that uses a ton of Facebook technology, for their ad network or even login type technology, and you say, hey, we're going to make you kind of this first step toward bringing our messaging services more together. WhatsApp is going to be a totally different challenge. But yeah, people weren't happy because they like the fact that Instagram is Instagram and Facebook is Facebook. They don't necessarily want those two blended, but that's kind of what Facebook wants.
And yet, Facebook is planning to put its brand name, Facebook, on both Instagram and WhatsApp. I still don't understand why.
I'm a little confused as well. I think their statement was something like, we want to be clear about what products we build. I was speculating that maybe some of it has to do with their new privacy deal with the FTC. Maybe they have to be more clear, here's the data we're collecting, and if we add the Facebook name to these other apps, maybe that protects them in some way. That would have been easy for them to say, and they didn't say it. I don't really understand, because Facebook has the brand is not strong right now, and they're basically saddling two stronger brands, WhatsApp and Instagram, with the Facebook logo. I'm not sure why they would want to do that.
In the midst of a lot of scrutiny about Facebook's power, at the highest levels of the U.S. government.
Yeah, I mean, we're talking about an FTC antitrust investigation that's currently ongoing, right? So Facebook has always been a little bit brash in the sense that they don't necessarily let these outside scandals stop them, right? They launched Portal a while back. They're trying to launch Libra, a cryptocurrency, in the midst of all this stuff. They don't seem worried.
Fast and break thin.
That's the motto. They say it's not the motto anymore, but their actions kind of say otherwise.
All right, Bloomberg's Kurt Wagner will keep us posted on how these plans evolve. Thank you. All right, I want to get back now to Samsung Unpacked, where the South Korean company has announced the latest additions to its Galaxy Note line. The Galaxy Note 10 smartphone comes as the company grapples with waning chip and smartphone demand amid global trade tensions. Joining us from Brooklyn to discuss where the event is happening, our very own Mark Gurman. So, Mark, what are you most excited about that you've seen today?
Hi, Emily. I think the biggest thing is the screen size, right? That is the foremost, most impressive change. It's really one of the only changes visually wise. There's the new 6.8-inch Note 10 Plus, and that really makes me want, a bigger iPhone. The iPhone XS Max right now maxes out at 6.5 inches, and you could really tell that the Samsung's bigger screen, you can really see video more clearly. It's better for gaming, better for productivity. So hopefully Apple goes in that direction. So that's definitely the most impressive thing, and alongside the new 5G model as well.
So how is this going to impact sales? Obviously, there's competition from Apple. There's lots of things going on with Huawei, and in general, the smartphone market globally is slowing down.
Yeah, my view is that this is going to do nothing to turn that around. This is not going to give new growth to the smartphone market in general. People are not going to, buy their first smartphone because of the Note 10. People are not going to switch away from the iPhone because of the Note 10 and the Note 10 Plus. What will happen, though, are people on older Notes, whether that's the Note 6 or Note 8, of course not the Note 7 because of the whole battery fiasco, or people from older other Samsung phones, they're going to want to upgrade to this. But, as you know, Emily, as we talked about so many times, the combination of a lack of major new features with sky-high prices north of $1,300 now for the high-end big model of 5G, that's a lethal combination for bad news, right? You can't charge those kinds of prices without adding revolutionary new things and expect people to upgrade on an annual basis or every 2 or 3 years. So that's the real problem at hand. I don't see that changing because of the Note 10.
Now, you've reported that for Apple, when Apple unveils its iPhones in September, the updates there will also be incremental, but there's a big design upgrade, design overhaul coming next year. Is that the same for Samsung, that next year there'll be a bigger difference, let's say, between this year and the year to come?
Yeah, I think it's actually that Apple and Samsung are on opposite schedules, right? It just so happens that last year and this year are going to be very small incremental years for new iPhones. I mean, the XS and XS Max, I look at those as some of the smallest year-over-year upgrades we've ever seen for an iPhone, and I think I'm going to be saying the same thing come next month when they announce the iPhone 11. But Samsung actually seems to view their S10 and S10 and Note 10 devices launched this year as actually bigger radical changes like the iPhone 10 was in 2017. So I don't anticipate big news from Samsung next year, but we'll see if they keep rolling out new folding devices, and I think that's where a lot of their market demand is going to be coming for in the future.
So let's talk about that, because the big foldable phone that was supposed to have a huge debut had a lot of problems, which you discovered when you tried the phone out for yourself. Are these phones that Samsung is unveiling now really ready for prime time?
Yeah, two words we didn't hear on stage today, Galaxy Fold, but I do think that the S10 is going to be very different. I mean, it was so quickly and easy to discover fundamental flaws with the Galaxy Fold just minutes into playing with them a few months ago when we first got our hands on the Fold. But the S10, I had a little bit of time to play with it today. I had time to play with it the other day, not an extended period, but these things seem as solid as last year's models. I don't anticipate any fundamental issues with them.
And quickly, Microsoft CEO Satya Nadella just spoke on stage. Tell us a little bit more about the partnership between Samsung and Microsoft.
Yeah, they really didn't announce too much. They've had some partnerships in the works for years now. They're expanding it a little bit. They're opening up the phone app on Microsoft Windows 10 to be able to support the new Samsung phones. The Note 10 will be sold in Microsoft stores, and there'll be deeper integration between Microsoft and Samsung Cloud Services. Not very groundbreaking, but it's just another notch on Microsoft's belt for working with more companies.
All right, Bloomberg's Mark Gurman. I'll let you get back to the event. Thanks so much for joining us. And that does it for this edition of Bloomberg Technology. We are live streaming on Twitter. Check us out there at Technology, and follow our global breaking news network TikTok on Twitter. This is Bloomberg.